There has been a lot of predictions on when this recession will end. Some analysts believe this recession will end as soon as next month during the holiday season. Others believe that we're going to have an Armageddon type of economy with years of depression worse than the 1930s. But by looking at recent past downturns and the control the government has over the economy, we can properly estimate a timeline. Goldman Sachs has been on the record stating that this recession will last well into 2023. But why will it last another year? How could it possibly look in 2023 during a recession? And how can we properly invest and manage our money during this downturn? Comment down below on how long you think this bear market will last and how will it look. And make sure you stay up to date by subscribing to this channel for some content around real estate, around personal finance, and the economy as a whole. Going back to Goldman Sachs' opinions on the state of the economy, one of their strategists stated that the conditions that are typically consistent with an equity trough have not yet been reached. So essentially, they believe we haven't reached the bottom of the recession, that the Fed isn't done hiking interest rates, and the stock market hasn't completely bottomed yet. They do believe, however, that we will start seeing a rebound towards the end of next year with the S&P 500 closing around 4,000 points, which is about 1% higher than what it closed last Friday. Now, this Yahoo Finance article that shared Goldman Sachs' opinions on the current state of the economy also had Morgan Stanley share their opinion. One of Morgan Stanley's strategists believes that the first quarter of 2023 hit its bottom and that the S&P 500 will go as low as 3,000 points, which is around 24% less than what it closed this past Friday. But why do so many analysts believe that this bear market will last well into next year? Well, one of those reasons is because a lot of strategists, analysts, and experts believe that what the Fed is doing by hiking up the interest rate, that has not been impacted or felt across many sectors of the economy. And it may take a couple months or even a full year to really show it in the stock market and in real estate. For example, real estate usually has a delay into showing the impact of the economy on the real estate market. So for example, the Fed hiking interest rates this month, that may not be felt or reflected in the CPI report in the real estate market until sometime next year, maybe in April, May of next year. And even on top of that, even though people believe interest rates will become stable, they still believe that the Fed is going to increase it well into 2023 for a couple more months. The St. Louis Fed President James Bullard sees the Fed hiking interest rate as high as 5 to 7%. Now, that is just the Fed rate. What that looks like for average day consumers is mortgage rates around 10%. So this can be good for savings account, but bad for people looking to take out a loan or use credit cards. So even though the Fed is hiking up interest rates, we still have inflation. We still have prices across the board like real estate, food, and energy at all-time highs. And in order to curb that even more, the Fed is just going to continue hiking up interest rates until it shows up on the CPI report that these prices are down, even though these sectors are being affected. The Fed usually focus on the CPI report. And so that will lead us to an even longer bear market that can last well into 2023 and even into 2024. And so you can see by the Fed just looking at the CPI report, that can be an issue because at one hand, prices can be dropping, but those price drops won't be reflected into the CPI report until months later. And so since the Fed is looking at, oh, okay, the CPI report is still showing high prices, even though today they are lower and inflation is going down, that may not be reflected until months later. And so the Fed is just going to continue hiking up interest rates until they see inflation slow down on the CPI report. Now, the San Francisco Federal Reserve President Mary Daly stated that the real impact of Fed hikes are likely bigger than what the target rate implies. Essentially, what she means is that what the Fed is doing by aggressively hiking the interest rates, there are sectors that are being affected by those aggressive rate hikes, but it's not showing up on the report. They're not realizing the true impact that what they're doing today actually does have an impact on these sectors right now. And so let me just quickly break down what the Fed rate means. So you hear on the news that the Fed rate is anywhere between 3.5% and 4%. And as a consumer, that doesn't sound that bad, right? 4%. But that's the rate at which banks borrow from each other. And so that's actually pretty high for them. And so they carry those extra expenses and those costs down to you through their loan products. So if you're borrowing using their loan product to buy a house as a mortgage, or you're using their credit cards or a car loan, those rates are even higher than that Fed rate because they're paying more to borrow money. And so that's why a Fed rate between 4 or 5% is translated to a mortgage rate of 7 to 9% for you all, or for just consumers, for me too. And so the Fed rate is essentially what the banks borrow at, the rate at which the banks borrow at, and so they carry that cost down to you through their loan products. Now, the CPI report, the inflation report, did show an improvement in the month of October, and that's why we had a slight rally in the stock market in the month of November, but we are nowhere near the 2% inflation rate that the Fed is actively trying to pursue. And so investors need to be wary of that, so we just don't throw money into the stock market and inflate it even more, and then the Fed hikes the rates even more than what they originally planned to, because investors are seeing a slight improvement in inflation, even though inflation is still mad high, and then they put all their money into the stock market, and then the stock market goes back up, and then the inflation report comes back even higher, and the Fed hikes interest rates even more, and so we have inflation and we have higher interest rates, and it's just a conundrum, and we're just going back and forth between high inflation and high prices. And so that's why as investors, you have to just take your time, wait until it bottoms out, wait until the inflation comes even lower in order to invest. Lindsay Piegzi, chief economist at Stifel, stated that the recent improvement in inflation has blinded many investors, and that there is a need to aggressively continue along a path to lead to higher rates. Expert hedge fund Bill Ackman, who famously shorted during the pandemic and made billions of dollars, has stated that we are nowhere near controlling inflation. He states that we think inflation is going to be structurally higher going forward than it has been historically. And so as you can see, a lot of experts believe that this recession will continue well into 2023, and that we possibly might have a rebound towards the end, but not much of a rebound. But what can you do during the 2023 year, during the slowdown of the economy, in order to invest and properly keep your money protected? Well, since stocks are lower, this may be the perfect time to invest. During a recession time, it's good to invest in stable companies that are tried and true, that won't go bankrupt tomorrow or a week from now. Those companies that are staple companies, that are brands that everyone knows about. These are the type of companies that usually last during a recession. Energy and resource stocks usually does well during a recession. Also, your basic necessities like food and water and toiletry. So companies like Walmart, Walgreens, Johnson & Johnson, they usually do well during a downturn. Real estate is another great asset to consider during a recession. As the Fed continues to increase the interest rate, home prices will decline. I know it takes a couple of months until it's reflected on home prices, the higher interest rate, but eventually we'll come to a point in 2023 that I believe that the Fed hiking the interest rate will be significantly reflected on home prices, and that will be the perfect opportunity to invest in real estate and buy a home at a discounted price. Once again, what are your predictions? Do you think that the recession will last well into next year? Do you think it's going to end next month? Do you think we're going to have a depression? How are you preparing for this market recession? Do you think this will be one of the few or only chances to get assets at lower prices? Let me know down below. All right, talk to you all.